this, okay, hold on, ready? Okay, and action. Okay, so this exercise is to get you basically to start training your brain to start thinking in market terms. Okay, so what I'm going to do is we're going to do it first. I'm going to just start asking you questions, right? And then you guys are going to yell out the answers. Okay. When you're working in a real life environment, basically I'm asking questions, and you are basically going to have to answer the question as fast as you can. Okay. So what's happening is you're going to be in a room with a bunch of people, and everybody's going to be competing against each other. In Wall Street, you're basically, it's whoever answers the questions the fastest wins, okay? And everybody competes against each other, okay? Because you're working in a very dynamic environment. You're trying to get to the solution as quickly as possible. You're trying to get the information so that basically you can come up with what your trade's going to be, okay? So 4 o'clock in the morning, right? What time is it in New York?
7.
And what time is the market open?
6.
In New York.
6:30.
In New York.
9:30.
Got it. Okay. So basically, we on the West Coast, we got to get up earlier than everybody in New York, right? So you got to get up, basically be in the office by 4 o'clock. You basically have to do all your research. By 5 o'clock, you're basically placing your trades, and by 6 o'clock, the bell goes off and you're placing the trades. Okay. So it's really tough out here on the West Coast because of the East Coast time. And then at basically 8 o'clock in the morning, what time is it in London? What?
2 p.m.
In London? No, it's like 5. Yeah, it's later in the day.
2 p.m.
Right? So when London closes, basically the West Coast opens. Okay? And then what happens at the in the morning? When we get to work, what's happening to London? It's closing. Exactly. And then in the afternoon, when New York closes, who's opening? No, Tokyo. Okay, so basically Tokyo, London, and New York, you can trade 24 hours a day. Okay. Anybody want to do global equity trading? Anybody interested in doing global equity trading? Anybody interested in that? I got a job at Pansera out of Orinda. The guy used to be ex-Barclays guy, before Barclays got bought by BlackRock. He's looking for somebody to train as a global equities trader. You basically show up at the office at 5 in the afternoon, and you get off in the morning at like 9. So you do your 8 hours, but you trade all night. It's kind of a weird time you're totally counter to everybody else. But where else are you going to get equity trading, right out of college? And they're going to train you. So maybe you lose a lot of sleep for a couple years. But who's going to hand you an equity trading position on a global basis? So again, what are you willing to sacrifice?
What was the name of that place again?
Pansera. Pansera out of Orinda. Look them up. Okay. But they're looking for some salespeople, and they're looking for a global equities trader, somebody you can trade at night. Okay. Yeah, just yell out the question.
Why do people not trade pre-market?
They do, here in the United States, they'll trade the futures pre-market before it opens. So you can get an indication of how the market's going to open by trading in the derivatives market. And then there's other markets that are not exchange traded, like Archipelago, I think is the other one, and there's some other systems that allow you to trade in off-market market times.
Yeah, there's some that allow you to trade at 4 a.m.
Yeah, some of them can trade 24 hours a day, but I don't know what the liquidity is. But most markets trade within certain time slots. They try. It's around New York, right? New York time. Okay. All right. So where did the Dow Jones Industrial Average close at 1 o'clock today, Pacific time? Where did it close at? Just yell it out. Come on,
up
traders.
8, 9 points.
What is it?
Up 8, 9 points.
No. What's the level?
29,379.
Okay. Is it up or down? By how much?
88.
How many points in that? What's the percentage?
43.
Yeah. So is that a big move? Yeah. So there was no major news that came out. Okay. So if the Dow Jones Industrial Average dropped 250 points, roughly, 1%, would that be a major move? It'd be a move, so there's probably news. But if it dropped like 100 points, it's noise. If it drops 250 points, there's probably some news that came out. If it dropped 500, you had a major news event. And if it drops 1,000, you had a major event. Okay? If the market goes up 250 or 500, very rarely will it go up 1,000. So basically, very rarely will the market go up or down 1,000 points. Very rare. But to go up or down 500 points is probable. There's probably some kind of major news event that caused it to move up and down by that amount. If it went up or down 250 points, there was probably some news. But if it went up or down 100 points, it's just that could be just in the range of just white noise. Okay, just volatility. So you said it was up?
Yeah.
Okay. Was there anything in the marketplace that would drive the stock prices, continue to drive stock prices up? Is it at an all-time high? Is the index at an all-time high? Are you looking at the index?
No, it's not all.
Are you guys looking at the chart? You need to be looking at the stock chart. Has it been trending upwards?
Yeah.
Yeah, obviously it hit an all-time high sometime during the day.
Okay, there you go. So all-time high. So what would be the effects that would cause the stock market to reach an all-time high? Give me a couple reasons. Don't raise your hand. We don't raise hands in the real world. We just yell stuff out.
Unemployment is arguing to reduce their tariffs.
Who did?
China.
Reduce their tariffs?
Yeah.
Yeah, that would have a positive effect.
Unemployment.
Unemployment rate is still continuing to be low. Didn't the payroll numbers come out at like 250,000? And then the Bureau of Labor Statistics is going to announce their numbers tomorrow, along with the unemployment rate, so that's going to be a big move. What do you think the unemployment rate's going to do tomorrow? If the payroll numbers were 250,000, what do you think the,
Unemployment's going down.
yeah, or stay
Low.
stay low?
Yeah.
And if unemployment is low, what does that tell you about the economy? Yeah, it's probably still going to be relatively strong. If it's going to be relatively strong, then what do you think consumption is going to be? High in investment, earnings, stock prices? Yeah, so if there's positive news that comes out, if we hit 200, 250 in job growth numbers for the month, stock market will go up more. And unemployment's already at a frictionally low level. I don't think you can go any lower than it is now, but who knows? Right? And things are booming again because of because the Federal Reserve is injecting billions of dollars through the repo market and re-stimulating the economy because it was going into a recession. And they injected liquidity and pulled it back up again. And what did the Federal Reserve do this week in regards to interest rates? You guys should be just Googling this stuff.
They lowered interest rates?
They didn't lower, they actually kept them the same.
Oh, okay, yeah.
Yeah. But they actually are lowering interest rates because they're printing money.
Mhm.
And actually the yield curve inverted again. Parts of the yield curve inverted again. And I'll go through all that inversion and stuff like that. So I'm kind of training you on this stuff. And I just talked to somebody today who's interviewing for an analyst position, buy side and sell side, at B of A in New York. Okay? And the questions that they gave her to answer was, what's WAC? What's CAPM? What's best efforts? What's firm commitment? What are the intrinsic valuations methods? What's DCF? What's, all of the stuff that you've learned in all your finance classes. So it's the same stuff, okay? Where's oil trading right now, per barrel?
51.
Is it up or down? Okay, and where has it been trending? Has it been trending up or down? It's been trading down, why?
Coronavirus.
Got it, so, lower consumption, particularly out of China, which is a major importer of Middle East oil. Right? So, and overall economic slowdown in the emerging markets. Although it seems like the emerging markets have bottomed out, but they're still fairly weak, and definitely Europe's weak too. So that's just going to cause more supply. What about geopolitical uncertainty through the Straits of Hormuz? Would that have an effect on oil prices?
Yeah.
Would that have an effect on oil prices? What happened in the Straits of Hormuz over the last 2 years? What's going on? Just Google it. Can you get this information? Yeah. What happened in the Straits of Hormuz over the last 2 years?
Things have been difficult to get through there. 'Cause
Why?
Iran.
Because Iran basically has been blowing up, Saudi Arabian ships. What's the religion of the Iranians? What's their religion? Say it, you got it.
Shia.
Shiite Muslim. What's the religion of the Saudi Arabians? What? Sunni. Okay, do they like each other?
No.
Okay, so you have basically geopolitical, theocracies basically battling it out in the Middle East and basically using oil in the Straits of Hormuz as basically the proxy, for these proxy wars. And if the Iranians are basically blowing up oil tankers in the Straits of Hormuz, what does that do to the supply chain? Supply flowing through the Straits of Hormuz. Yeah, it's going to be disrupted, and what does that do to oil prices? If it's going to cause it to go up. So what did the Americans do? So what did the Americans
Source
do?
oil from somewhere else.
Or, no, what did they do? What did the Americans do in response to Iranian tax on oil tankers? What do they do? Come on, you guys. What did the Americans do? What? Who said it? What? Well, they sent in their warships, right? To basically protect the oil supply chain, oil supply lines. Yeah, they sent in the warships. And maybe they bomb, send some, rockets into the periphery there where the missiles were being launched. Okay, you got to think in geopolitical terms because they have an effect on all of the asset classes. Where's gold trading on it per ounce right now? What is it? 1569. Okay. When we were tracking oil over the last 2-3 years of my class, it was trading in a trading range around 1,400 an ounce. Where's it trading now? Yeah, is that higher or lower than 1,400? Yeah, so it's broken out. It's probably reaching a resistance. What's going to cause gold prices to go up higher? Give me some factors.
Money, the value of currency goes down.
Yeah, exactly. So if my purchasing power is going down, I'm going to need to hedge off the deterioration in purchasing power due to devaluation in the currencies. So I'm going to go into a hard asset, which is normally gold, to basically protect my purchasing power as a store. Okay, that's one. What else would cause gold prices to go up? You can Google it, look it up. You really easily start finding the factors. We're going to go over this in a little bit more detail, but I want to get you guys start trained. If you don't know the answer, Google it. If you don't know the answer, look it up.
People are uncertain about future market outcomes?
Yeah, if the markets are more volatile, which means they're more risky, would you be in stocks? No. So you're going to sell your stocks and buy gold and bonds. Exactly. Okay. I'm trying to train you to be a trader. Okay. Give me another factor that would drive gold prices up. Instead of sitting there trying to figure it out, Google it. What factors drive gold prices? And then it's
Interest rates go up?
if interest rates go up, okay, if interest rates go up, are you getting a higher or lower yield on bonds?
Oh,
If interest rates go up, are you getting a higher or lower yield on bonds? Higher yield, okay? Does gold give you an income return?
no.
No. So if interest rates are higher, right, and I can buy a bond and I'm going to get a higher income return, and gold doesn't produce any income return, just capital appreciation. If interest rates are high, am I going to buy bonds or am I going to buy gold? I'm going to buy bonds. So I'm going to sell my gold and I'm going to buy bonds. So in a rising interest rate environment, I'm buying bonds over gold because gold doesn't produce income. Okay? Give me another factor that would drive gold prices up. Monetary policy, so if there's over-accommodated monetary policy, okay, that creates inflation, okay? Are you gonna buy gold? If there's inflation, are you gonna buy gold?
Yes.
Yes, yes. Because is gold a commodity?
Yeah.
Yes. And are commodity prices and inflation highly correlated to each other? Yeah. Is the CPI index, are commodities, if gold's a commodity, will gold prices correlate with inflation? Yes. So is gold an inflationary hedge? Yes. Okay. So if inflation is going up, to hedge off the deterioration in the purchasing power of my dollar, I'm gonna buy what? I'm gonna buy gold. Okay. I'm gonna buy gold to hedge off the inflation. If the inflation is going up, what happens to the purchasing power of the dollar if inflation's going up? It goes down, okay? And if I want to hedge off the devaluation or the depreciation of the currency due to inflation, I'm going to buy what? Gold. Got it. Okay, so I'm training you, okay, in the logic. And then we're going to do more formal logic, but I'm trying to get you guys to start thinking like traders, okay? And the traders are really smart. They understand, you know, they understand economics, they understand finance, they understand accounting, and then the brilliant hedge fund traders, they understand psychology, sociology, they understand politics, they understand all that stuff, because they're trying to formulate a view and then be able to trade off that view using multiple toolboxes with multiple tools from different disciplines to try to come up with the solution, okay? All right, where's the 10-year treasury yielding right now? What is it? No. 164, okay, is it up or down? Is the yield up or down? Is the yield up or down on the 10-year treasury?
Yeah.
The yield is down? The yield, so 10-year treasuries yield, 10-year treasury yields have fallen, is what you're telling me, okay? So 10-year treasury yields have fallen, okay? Now, when there's high demand for bonds, what happens to bond prices? They go up. What happens to interest rates? Got? That's a question. There's high demand for bonds, bond prices go up, and interest rates go down. Perfect. Okay. So if interest rates are going down, is there higher or lower demand for bonds? If interest rates go down, is there higher or lower demand for bonds? Higher. Got it. What would create higher demand for bonds? What are investors looking for when they buy government bonds? What are they looking for?
Stable,
What?
like stable investment.
You mean, give me another terminology. If I buy a government bond, what am I buying? Two things I'm buying.
Low risk.
Lower risk, exactly. So if there's higher demand for bonds and bond prices are going up and interest rates are going down, what does that tell you about the risk of the market? Higher risk. So they're moving towards a risk-free investment, a safer investment, because they perceive more risk in the future. Got it. What else would cause demand for bonds to go up? What? Okay, let's talk about that. Where are interest rates in Japan and in Europe? Negative. What's the yield on the 10-year treasury? What's the yield on the 10-year treasury? Sharon, you already said it.
1.64.
Okay, 1.64. And what's the 10-year bund in Germany? What's the 10-year JGB in Japan? Where's it yielding? Can you look it up?
What was that again?
Where's the 10-year JGB, the Japanese bond? And where's the German bund? Right now, the 10-year. So now we're looking at global interest rates.
Germany has negative 0.37.
Got it. So would you rather invest 1.64 in the United States or negative 1 point, what did you say?
Negative 1.37.
What, negative 1 point?
I mean, negative 0.37.
Got it. So where would you rather invest? In the United States or in German bonds? United States. Is that going to increase demand for the U.S. Treasury yield?
Yeah.
Treasury? Yeah, so it's going to cause bond prices to go up and interest rates to go down. So we could have massive capital flows coming out of Europe because maybe they think that European prospects and economic growth in the future are actually going to go down, and they'd rather be, there's a yield spread differential between the United States and Germany on the 10-year. And where would you rather be, 1.64 or negative 0. Whatever you just said? Yeah, okay, so that can do it too. Where's the 10-year JGB yielding right now? Got it. So would you rather be investing in Japanese 10-year bonds or US 10-year bonds? Got it. So global capital flows. Anybody know what the Fisher equation is? Can you tell me what the Fisher equation is?
Real rate plus rate of inflation.
Well, it's not the rate of inflation. Be more specific. Be more specific. So it's the real rate plus what? No, you gotta be specific. You gotta look at the terminology because you're gonna be talking to people. You know, how many people are finance majors? Okay, do you need to talk the finance language? Yep, so you need to be specific. You can't make up your own stuff. So it's real rates plus what? It's 2 words. The first one is inflation.
And interest?
Inflation, can you look it up? What?
Nominal.
This is the nominal interest rate right here. This is the real rate.
Inflation rate.
It's not the inflation rate. See if you can find the exact terminology.
Real interest rate?
That's this one right here.
Okay.
That's the base rate. I'm testing you to see if you can find the information. The information's not up here because I'm not going to tell you. You need to find the information. I can teach you finance, but I got to teach you how to learn finance. You can't learn finance by not doing the research. Got it. Yeah. Inflation expectations, exactly. Okay. So, and I use different terminology. This is my thing for inflation expectations. Okay. Got it. Real rates, real interest rates are more cyclical. Okay, I've been writing these notes down. Are basically cyclical and secular. Okay.
And what?
Cyclical and secular. Okay. Cyclical and secular. Okay. Cyclical and secular.
Interest rate?
The real rate. The real rate is cyclical and secular. Okay. Which means that it doesn't move. There's not a lot of volatility. It moves over time, based on longer term cyclical and secular trends. Okay? So basically the real rate is constant. Okay? So if we're looking at movements in interest rates, so where's the majority of the movements in interest rates coming from? Inflation expectations. Got it. Okay. So if inflation expectations go up, what happens to nominal interest rates? Goes up. Got it. And if inflation expectations go down, what happens to nominal interest rates? They go down. Got it. Simple logic. Okay? This is a simple Fisher equation. This is Irving Fisher invented basically the notations around nominal interest rate equation. Okay? The guy was brilliant. We use his models a lot. So if inflation expectations go down, the nominal interest rates go down. What happened to the 10-year Treasury yield? What happened to the 10-year Treasury yield? Did it go up or down? Sharon, what did it go? Where did it go? Is it winters or winter? Winter? Winter, did the 10-year Treasury yield go up or down? Did the 10-year Treasury yield go up or down? Did the 10-year Treasury yield go up or down?
It went down by 30 basis points.
Yeah, it went down. So what happened? So if 10-year Treasury yield went down, what did inflation expectations do?
Down.
They went down. Got it. Okay. And if inflation expectations went down, what is the reflection of economic growth in the future? Up or down?
Slow.
Up or down?
Uh,
Is there a correlation between economic growth and inflation expectations?
yes.
So if inflation expectations went down, what's the view by the bond market of future economic growth? Down. It's going to slow. Okay? So the bond market, okay, and the yield curve, since they're future looking, 1 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year maturity bonds, basically give you a view of what future economic activity is going to be based on future expectations of inflation. So it's awesome. Yield curve and basically inflation expectations and interest rates are future predictors of economic activity. It gives you information. Because the bond market is massive. It's trillions and trillions and trillions of dollars. So you have basically thousands and thousands and millions of analysts watching basically what's going on everywhere. And the market is basically determining prices and interest rates for bonds across different maturities across the yield curve. And I'll go through more of that, but I'm just kind of wetting your whistle here.
Just wonder, the interest rate goes down and the 10-year treasury goes down, right?
What?
The interest rate goes down and the 10-year treasury goes down.
Yeah, it depends on what interest rate you're looking at. The yield to maturity on the 10-year treasury is also called the 10-year interest rate. So it's also the yield to maturity and the interest rate. Government securities are risk-free, okay? Risk-free bonds, okay? Because the Federal Reserve can always print money to service the coupon payments and the principal payments. The Treasury can always raise taxes to pay off the bond coupons and to pay off the principal when the bonds come down. So there's no default risk, okay? There's still inflation risk premiums, but there's no default risk premiums. So they're considered risk-free rates, okay? And if I'm a corporation and I want to issue 10-year bonds, I'm going to start with the 10-year Treasury yield, and I'm going to start tacking on risk premiums to get to the yield to maturity on my corporate bond, and I'll walk you through that stuff later.
Can you talk a little bit more about the yield curve? You said that it's a future predictor for trends in the bond market. Did I get that right?
In the economy.
Oh, okay.
Okay. And I'll go through based on the, in the pre-test, there's a yield curve component. I'll walk you through it. But I would go ahead when I start using terminology, I would start doing the research on this stuff. So that when I talk about it in class, you're not hearing it the first time because you've already done some of the research. Again, the goal is, and some of the best finance professors are, I'm not going to teach you finance. I'll teach you some finance, but I'm going to teach you how to learn finance. That's the key, okay? Because you're going to go to work and you're going to get these problems, and they're not going to tell you the solution because you're going to have to go figure it out, okay? And then you try to figure it out, then you come back and then we work together on the solution, okay? I don't have time to walk you, when I'm busy managing 50 traders, I don't have time. You need to go do it, and then come back to me, and then we work back and forth. Okay, it's a lot quicker. Did that answer your question?
Yeah, thank you.
Okay, cool. So does everybody understand the Fisher equation? And so that's basically it. I'll walk you through the supply and demand analysis around all of these asset classes, but I'm just trying to get you started. Okay, so where is the dollar to the pound and dollar to the euro? And when we're looking at the pound, the dollar to the pound and dollar to the euro, what's the major factor that's going to have an influence on the appreciation and depreciation against the pound against the dollar?
Inflation, export.
Yeah, one is going to be, okay, exports, inflation, or what's the major overriding factor?
Financial demand within that country.
Now, come on, what's going on? You can just Google it.
European Union.
You're getting closer. Brexit. Got it. And how long have how long has the UK been going through geopolitical uncertainty around Brexit? 2 years. Got it. And then when the Brexit was announced, what happened to the value of the pound? Did it appreciate or depreciate? Depreciated. Got it. And when a currency depreciates, your imports, right, that come in, do they become more or less expensive?
More
Or
expensive.
more expensive, and what does that do to import inflation?
It goes up.
It goes up. And if inflation's going up, what happens to the value of the pound? It goes down. What happens to your purchasing power?
Goes down.
What happens to the overall social welfare and the social conditions? It goes down. Your standard of living goes down and your social welfare goes down. So are the people better off or worse off? Worse off. What else has happened because of Brexit? What's happened to the City of London?
Financial firms are moving out of them
Got
because
it.
regulations are changing.
Financial firms are moving out of London and moving to,
Europe, Paris.
they're going to Paris, Brussels, Frankfurt, other places in the European Union. What does that do to jobs?
Moves them out of London.
What happens to real estate prices? They go down. Exactly. So your asset values are dropping, your tax base is dropping, inflation is going up, purchasing power is dropping, standard of livings are dropping. Okay? All because of populist politics. Okay? Are they better off or worse off? I don't know, you gotta ask them. Okay? They voted it in, Boris Johnson has voted in, they restructured the parliament. It looks like he is basically going back into negotiations with the European Union. Do you think that the Londoners, do you think that the UK is going to be in a better negotiating position when they go back to the European Union and renegotiate their trade deals? No, they're probably going to be worse off. So overall, the UK could be in a worse off economic position, maybe in a better political position, but they could be in a worse off economic position over the long run because of it. Okay? So I'm just trying to get you to start thinking about factors that affect currency values. Okay? What about what is the dollar to the pound trading at? How much does it cost me to buy a pound?
77 cents.
Okay, so you need to stay focused here. Stay focused. How much does it cost me? Now flip it. How much does it cost me to buy a pound? Dollar to the pound, not pound to the dollar. 1.29. So it cost me $1.29, right, to buy a pound. How much did it cost me to buy a pound 2 weeks ago? So it cost me $1.29 today. How much did it cost me to buy a pound a couple weeks ago? 130. Okay, 130. So was it more or less expensive? More expensive. Okay. So now that it cost me 120, 129 from 130,
Yeah.
right? Is it more or less expensive?
Less.
Less expensive. So did the dollar appreciate or depreciate against the pound? Appreciated. Got it. Exactly. Okay. Got it. All right. So that's kind of how we think. All right. What about the euro? How much does it cost me to buy a euro?
109.
What is it?
109.
1.09? Yeah, 1.09. So it cost me $1.09 to buy a euro. How much was it 2 weeks ago or a month ago? It's $1.09 to buy a euro. How much? It was 110? Okay, so is it more or less expensive? No, it went from 110 to 109. So it's less expensive. What did the euro do? Did it appreciate or depreciate against the dollar? You guys are good. That's it. All right. So that's the name of the game. All right. So every class, or almost every class, you got to start tracking the markets. What are they trending? Are they up or down? By how much? And then what are the factors that are affecting these major asset classes? We're all totally exposed to these major asset classes. Okay? Our life basically depends on our economic wealth. Depends on it. Do you think that you are exposed to these 5 major asset classes?
Yeah.
Do you think that you're exposed to them?
Yes.
Yeah. Does anybody have any grandparents?
Yes.
Yeah, do you have any parents?
Yes.
Do they have any wealth?
Yes.
Where are their money? Where's their money?
Investing.
Invested in what asset classes?
Equities and real estate.
Real estate, stocks, bonds, right? Maybe some global stocks and bonds, so you got currency exposures. In those portfolios, oil companies, maybe gold companies involved in there. There's not a lot of places to put your money. Bonds, stocks, annuities, life insurance, there's an array of financial products that you can invest in. And everybody's invested in the same financial products. So you're already exposed to it, okay? The question is, are you tracking it, okay? And a lot of my students think, well, hell, my parents have some money, I'll inherit that money. The grandparents, I'll inherit that money too. But a lot of them don't understand that some of your parents and some of your grandparents may live really long and they're not going to give you any money because they don't want to burn through all of their wealth. So you may not even get it, okay? I'm giving you guys a little financial planning here too. And then the other scenario is, if your parents and your grandparents do have money in real estate, you better know, your names better be on the accounts, okay? You better be on the title, and you better be in the wills, and you better be in the living trusts. Because if you're not, your sister's gonna get there. Put her name on it first. So when something happens, she's gonna get the real estate, and you're not. Because you assumed you were gonna get it the whole time. Okay? And I've seen that happen too. Yeah, the sister and the mom. Basically, the father didn't have an irrevocable trust, didn't have a living trust, didn't have a will. So he died intestate. And he had accumulated 4 apartment buildings in San Francisco. And the mother and the daughter basically forced the liquidation of 3 of the apartment buildings and walked away with $100 million. And the son got a $20 million apartment building. He's fine, right? But again, it destroyed the family. That's kind of the worst case there. So this stuff happens. So maybe a little homework for you guys. Call up your parents and your grandparents. Make sure you're on bank accounts and the living trusts and stuff like that. Get your names on the deeds and stuff so that you'll get it. Okay, if you don't, somebody else is going to do. Uncle Harry will get his name on the bank. Or the tax guy will definitely put his hand in and take your stuff. Okay, cool. Let's do the memos. Okay. So that exercise that we just went through is going to help you do your memos. Okay. And the memos are totally laid out. So that's all you got to do is use the template. Okay. Use the language that's already provided to you, and then change the data and change the logic. Okay. And then it'll make your life really, really easy. Okay. Usually what I would do is scan this and do a PDF conversion to Word so that all of the formatting rolls over nicely. Okay. And then I'm going to read through it and tell you exactly what to do. So here in the memo, just follow along. Right up here, 1-inch margin. 1-inch margin, 1-inch margin. So you have to have not 1 inch down here, but at least 1 inch around here. Aren't these memos beautiful? Yeah. Are the graphs all messed up? Are the graphs? No.
Wait, where'd you say the 1-inch margins were? To the right and left?
Yeah, right, left, and the top.
Okay.
1 inch. Okay. And then this memo right here is in caps. Okay, and I think that's maybe 16-point font size. Everybody know what a font is? Memo, what?
Yeah.
Okay, this is the font size. It's all going to be, all the text is in 12-point font size. This up here is in caps. 16, we can start with 16. Okay. These memos are extremely specific because you're going to walk into a corporate environment and they're going to have templates for you. Now, can you start changing the formats? Hey, Tom, you told me to write this memo, you gave me the template, but hey, I decided to do 2-inch margins on each side here. You guys have been doing it 1-inch margin for the last 30 years. We're going to do it differently now. Is that going to go over well? No. So you use the template. Okay. We work on these really hard. Okay. Then you got the date, to, from, RE, semicolon, indent. Okay. You're gonna do a tab, and it's gonna be flush right there, okay? I have a lot of students where the text is all crammed over to the side, there's no formatting. The second thing in your job descriptions, it says attention to detail. Attention to detail, which basically means no spelling errors, no capitalization errors, no formatting errors. It's got to be perfect, right? Because if I give this to a client and the formatting's messed up and the punctuation's off and the grammar's messed up, what does that tell you about the company? Yeah, exactly. Are they going to invest $20 million of their money in you? Heck no. They're going to put somebody else that can do it the right way. Then you put the date, to me, from you, and then use exactly this language. Stock price is forecast to fall or rise, depending on what you think it's going to be. Okay? 5% over the next 3 months. Okay? And we're forecasting out 3 months because we're going to be trading derivative contracts, option contracts, that basically last for 30 days, 30 calendar days. So option contracts are basically set up for 30-day increments. So we're trading options also here, okay? So you gotta pick either it's gonna go up or down. Now, stock prices over the next 3 months, test question, how much do you think stock prices could move in the next 30 days, or in the next 90 days? How much do you think the stock indexes could move in the next 3 months? How much do you think stock prices could move in 1 month, multiplied by 3? Do you think the stock market could go up 30%? No, heck no. Can it go up 10% over the next 3 months? Yeah, that's totally plausible, right? 20, no. 10, can it go down 20% in 3 months? Unlikely to. That's a very low probability. Can it go down 10% in 3 months? Yeah. Okay. So that kind of gives you a range, right? So it's just a matter of what do you think? Do you think it's going to go up or down? And then what's the magnitude? Okay. And bounded by plus and minus 10%. Okay. So you kind of set the range. Right? And in this case, it was 5%. So they're actually saying that stock prices are going to fall. Okay, by 5% over the next 3 months. Is that plausible? If economic activity is slowing, and then inflation expectations are falling, and interest rates are falling, what does that tell you about future economic growth?
Slow.
It's going to slow down. And if economic growth is slowing, what does that tell you about sales?
Down.
Down. Revenue?
Down.
Earnings?
Down.
Dividends?
Down.
Stock prices? Exactly.
Don't dividends stay the same though for some companies?
Yeah, they're managed, but we look, when we're evaluating stocks, we're looking at earnings and free cash flow.
Okay, but dividends typically stay the same?
Yeah, dividends are managed. It's a bad, I don't know why the books use dividends, as the numerator or the cash flow metric. It's so myopic.
Mm-hmm.
It's like a 30-year model. It has no relevancy to valuation, so it's really kind of, I don't know why they do it, okay? So we got that part, right? And then what you want is this line right here, you want a little space after the text to give a little white space, right? So that the eye can rest a little bit. And the same thing after the, after the line. You want a little space there too, before you get into your thesis statement, okay? So then you get into your thesis statement. We are tracking stock prices. So what are we tracking? Stock prices. So right, the very first sentence tells you what we're trading, the stock prices. Okay, and then it says, based on our research. Is it my research or our research? Our research, okay. I always see I and my and stuff in these things. That ain't gonna fly, okay, in the corporate environment. Okay? So based on our research, comma, we forecast stock prices to fall 5% over the next 3 months based on the following factors, colon. Okay? All that language is exactly the same. Okay? It's a template. Then it's 1, tensions in geopolitical climate. Would that cause stock prices to fall?
Yeah.
Yeah. If you think geopolitical crises are occurring, are you gonna be in stocks? No. Are you gonna buy or sell stocks? Sell. And you're gonna buy what? Gold and bonds. Got it. Okay. So does that logic make sense?
Yeah.
Yeah. 2, rise in inflation. So if inflation's going up, what's happening to interest rates? Going up, what's happening to the cost of debt and equity? Going up, what happens to the present value of future cash flows? And stock goes down. Got it? Does that make sense?
Yeah.
Yep. And 3, drop in consumer sentiment to its lowest level since 2016. If consumer sentiment is high, what are people doing? They're buying. And what's happening to consumption? Going up, what's happening to production? What's happening to sales? Revenues? Earnings? Stock prices? Got it. Okay. Oh, shoot. Okay, so let's turn it around. So if consumer sentiment is going down, what are people doing? Are they buying more or less? They're saving their money and they're buying less. What happens to sales? Goes down. Revenues? Earnings? Down. Stock prices? So you get it. So you have to check the factors to make sure that it supports your forecast. Okay? Up or down. Therefore, comma, we recommend the following 36 trades. Okay, not 26 trades, it's going to be 36 trades. So I check these in my, I'm going to have some of my TAs come in and work with you on these. Okay? So we can train you on the numbers. You already know how to do it. Yeah. Okay. And how many times do we go over this? How many? Once?
Well,
How many times did I sit down with you and go over these things?
a few, several,
Yeah, at least 3 times.
yeah,
At least.
at least.
Yeah, 3 times, got it.
For the trading terminology, like, right call?
Yeah, I'm gonna do that next.
Okay.
Yeah, and I'll walk you through those things.
Okay.
Okay. I'll give you like a little primer. The book has the definitions in there, and they'll walk you through those things. But I'll walk you through like an introduction to derivative contracts tonight. Okay. So therefore, we recommend the following 36 trade colon. Okay. Then we are trading 3 indexes. Okay, right there. We're trading 3 exchange traded funds, and we're trading 5 stocks. Okay. Underneath where it says tickers, we've identified the 3 indexes that we're trading the derivative contracts off of. Why am I using derivatives? Why am I using, the selling short trades and buying and writing the puts and calls? Why am I using derivative contracts?
To hedge the expected price movement of stock.
Well, there's that,
Is it
but
more cost effective?
yeah, it's more cost effective. I can totally leverage my view. If I think stock prices are gonna go up, I can buy a bunch of stocks, right?
That's going low.
That's really expensive.
Yeah.
But I can buy on margin, I can borrow money from the brokerage firm, but maybe I only have $100,000 to invest in these stocks. If I buy them outright, I can only buy 100,000. But if I go to the brokerage firm, I can borrow another 100 grand at 9%. So now I can buy $200,000 worth of stock instead of $100,000 worth of stock. So if stock prices go up, am I going to get a higher return on my equity?
Yeah.
Absolutely.
Yeah.
So that's why you would do it. And what about option contracts? If I have $100,000 to invest and I think stock prices are going to go up, can I control more shares by using option contracts than if I buy the shares outright or use margin? Yeah, I can basically control maybe with 100,000, maybe $1 million worth of shares by using derivative contracts as opposed to buying them outright or buying them on margin. So I'm leveraging my capital. And if I'm right, I win exponentially. If I lose, I could lose, okay? But there's ways of mitigating the trades so I don't lose as much. So the derivatives are really the tool to basically leverage your views if you're right, based on the financial economics. Okay, go ahead.
So when you're talking about these derivatives,
Yeah,
where in the recommendation does it say like, okay, maybe their suggestion is to have a position in the derivative, but how do you know when to get out of that position and how do you know?
I'll go through that.
Oh.
Okay, I'll go through. I'm not gonna get into too much of that because,
But for the memo, we just don't need to.
no, you just gotta memorize the up trades and the down trades. There's only two sets of trades,
Okay,
right? Because there's only two directions.
right, up and
Either
down.
they go up or down.
Right.
So when they go down, these are your trades.
These being puts?
Yeah, these are the trades that you would use if you're forecasting prices to fall,
Oh,
okay? So those are the sets of the trades.
okay,
It's exactly what you're gonna use.
okay.
If you think that the values of the prices are gonna go up, go to gold. Okay, on page 3. Those are the sets of trades that you're gonna use if you're forecasting the prices to go up. So there's only two sets of trades, okay? When prices go up and when prices go down, you use exactly those two sets you memorized, okay, and you use them. So it's a binary decision, right? It's either up or down, and there's only two sets of trades. Is everybody clear? Okay. So I tried to make this as logical as possible, but again, once you get these memos down, they're awesome, right? Because you're forecasting market trends, you're applying the economics, you know, to support your forecast direction. You've identified a magnitude of movement over a period of time. You're coming up with the trade recommendations for the proprietary trading unit or your own trades or your client recommendations to profit off the review. And then you're going to get into the data. I'll get into that in a minute. So these are the trades right here, although these are correct. Okay, and I'll go through them. Let me just go through them really quickly. So we're trading derivatives off of 3 indexes. We think that the value of these indexes are going to go down. So based on our view, we're going to write forward contracts, write futures, write calls on futures, and buy puts on futures. If we think that stock prices are going to go down, okay, what we can also do is go find 3 exchange-traded funds, 3 ETFs. One ETF could replicate the S&P 500, one could replicate the Dow, one could replicate the NASDAQ. Okay, so what you're going to need to do is to go on, do some research, and go find 3 ETFs based on these major market indexes. You can go to Franklin, Fidelity, Vanguard, Schwab, JP Morgan, Goldman. I mean, they all basically produce exchange traded. BlackRock, and then put the tickers right there. So go find 3 and put the tickers right there. The ticker symbols are what basically is the code. It's like a social security number for all registered securities that trade on the exchanges. Okay. And then if you think that the share prices, does everybody know what an exchange traded fund is? What an ETF is? An ETF is basically a basket of securities, okay? A portfolio of securities based on some strategy or some weighting scheme. And basically the portfolio trades as a share on an exchange. Okay, so before BlackRock invented exchange traded funds, where's BlackRock located?
San Francisco, downtown.
Got it. How many assets under management does BlackRock have?
7 trillion.
Something like that. Is that a big company?
Yeah.
Yeah, it's totally dominates the monopoly in the market space. Okay, first mover. Got it. So exchange traded funds. All right. So I got the shares. If I think the shares are going to go down, I can sell short those shares. Sell it at the higher price and buy it back at the lower price. I can also buy puts, where I make money when the share prices go down, and I can write calls when the share prices go down. And I'll walk you through that stuff in a second once I get through it.
Can't you also bet that stocks won't move, like that it'll stay within the range?
I could. I can make money doing that stuff too. But that's a different strategy where, let me go through this and then we'll go back to that. I'll answer that question, okay? And then we have 5 stocks. What you can do is go look at the major market indexes and pick the top 5 companies in the major market indexes and put their ticker symbols right there. So who are the major, give me the 3 top companies in most of these market indexes. Amazon, Apple, Google, exactly. You got it. So you have 3 tickers right there that you can do. And since the shares are just like the shares of the ETF, they're exactly the same trades. Okay? So if you know these, then you know these. Okay? Simple. So I got 3 indexes that I'm trading off of. I got 4 trades. How many total trades on the indexes? 12. Got it. I got 3 exchange traded funds I'm trading, and I got 3 trades. How many total trades? Got it. And I got 5 stocks and 3 trades. How many trades? And how many total trades? I got 36 trade recommendations that I can give my client, that I can send up to the proprietary trading unit, or I can trade myself. If this was an advanced class, okay, in trading strategies, maybe at like NYU or Columbia or even Golden Gate University has a real focused trading strategy courses. And what we would then do is take those 36 trades and put it into a simulated algorithms and simulated environment and test the 36 trades to find out what trades in the 36 are actually feasible. Because some of these trades are going to be really expensive, and I'm not going to make any money off of it because the puts are going to be too expensive. But maybe I can write the calls or go short or something that's a little more cost effective, because some of the other ones may not be feasible trades. Okay? So I would then simulate, test the trades, find out the ones that are actually feasible, and then place the trades once the market opens.
So for those memos, like for like the paragraph format, like we write the exact same wording except for we just change like what we predict.
Yeah, the factors,
Okay.
the percentage change, and if it's up or down.
The wording is the same though, right?
Yeah,
Okay.
use the structure.
Okay.
Because it's a template.
Yeah, okay.
When you start changing the template, we worked really hard on perfecting this language so that the only thing that really changes, is the movements and the factors and then the data, the supporting data that you put in, yes.
Could you run a Monte Carlo simulation on like a test portfolio
Yeah.
in Excel?
Yeah,
Have you done that?
no,
Okay.
but you could do it.
Okay.
To test the trade. You could go get the futures and the option contract data from the CME and the futures.
Do you need like a live index for that?
You need the data. You need the data to be able to test it. So, and then the option contracts, there's a whole strategy around it, or do you buy out of the money, do you buy out of the money puts and stuff like that, you create straddles, there's some of that stuff in the book and stuff that you want to get in to really the derivative trading strategies, but that's kind of beyond, this class and really beyond. I want to stick to the fundamentals, and then if you want to migrate into that and learn more about that stuff, but I gotta set the foundation that you can build off of to start doing more of that stuff.
Also, I see that the first page of the memos are on Canvas. Are you going to release like the other pages as well, or is it just one page? Is it?
No, there's 5 memos.
Yeah. Okay. So the 5 memos.
There's 5 memos of the 5 major asset classes.
Oh, so each memo is just a second.
Yeah, exactly. Yeah. And then what I'll do is I'll walk you through this. I'll do like a derivatives primer, tonight to walk you through, the derivatives. A lot of the stuff's in the books, you can read up on that there. And then what I'll do from the pre-test is I'll walk you through the microeconomics, the Marshallian microeconomics of the major asset classes. So that when you're reading and thinking about why the asset classes prices are moving and where you think they're going to go in the future, you can use the economic theory and the economic logic in the application to be able to make good decisions based on, the laws of economics. Okay. Yes.
So So do we pick which asset class we're gonna analyze for the first?
I would do stocks first, so that everybody's doing it.
Okay.
Do stocks, oil, gold.
So essentially, we're figuring out based on our research, where do we think stocks will be in 3 months from today?
Yeah, where you think stock prices are gonna go in 3 months,
And
based
why?
on the three factors.
And why?
And then find the data to support it, your forecast.
And you don't care about where, you don't want sources, you're not gonna, you just want.
No, I don't need the source. And then just usually what I'll do sometimes, some of the articles,
Just see what the analysis says.
some of the articles that you're reading will give you an indication, will talk about the macro factors that are driving.
So can we use analyst sentiment, sometimes we say we're bullish for those reasons, so can we incorporate that?
I would put your own primary data in here. Don't cite analysts.
Okay,
Cite actual data
okay,
based on actual factors.
okay.
Financial, economic factors that drive the prices up and down. I don't want you to be following other people, because the problem is those analysts might run you into a rabbit hole, right? I'd rather have you be the analyst.
Okay,
You can use them to guide you, but don't mention them here,
okay.
okay? You don't need the source, just give me the raw data.
What about the tickers?
The tickers, you gotta research them.
So we gotta like find tickers based on what?
Yeah, so, these are the ETFs, right, based on major indexes. These are the companies. I don't care what companies they are, because is there correlation? Do all stocks, when the stock market goes down, what happens to the majority of the stocks on the stock market? They go down. Is that systematic risk? Yes. Systematic risk is reflected in the beta.
But do we need to justify why we chose those stocks?
No, don't care. You're gonna do that in the portfolio selection. This is just an exercise.
Just a fun fact, S&P went up yesterday, but Tesla went down 100%.
Yeah, but that's only one cent.
Yeah, but it was just.
And why did Tesla go down? Because it was already
Profit
overpriced.
sharing, yeah.
It was already overpriced. And then a lot of those options are now in the money, so a lot of people exercise their options.
When you say that, that's one of the main reasons that the NASDAQ is so far away from the Dow and the S&P.
I don't know what the market weights. You gotta look at the market capitalization weights of the NASDAQ and look at the major companies that make up the majority of the market caps. Because the movements in the top 5 or top 10 or top 20 companies is gonna move the index.
Right.
So you gotta look at the weights. Okay, so let's stay focused on this. Okay? All right, so is everybody clear on the table?
Yes.
Got it. So the next is the data, okay? So there's 3 data points, right? And then 2 graphs. Now, the places I want to go get my graphs are, so I like to use stockcharts.com and bigcharts.com. A lot of students make a mistake, and they basically use 2 different sources, so the graphs aren't conformed. There's no conformity between them. They have to look like Parth did. He got all of his from the same source. So they look like brothers and sisters. Brother, sister, sister, brother. So they look consistent, okay? And you want to go back at least, for your charts, you want to go back at least 3 years. You can go back 5. But if I have 3-year price charts, what am I looking for? When I look at the charts, what am I looking for? Why am I going back 3 years?
Positive, negative, right?
I'm looking at trend, exactly. So the graphics and the data gives you an indication of the trends. And the trend should be consistent with your views, okay? And you don't need to refer in your data analysis here, you don't need to refer to the graphs. Just talk data, okay? So he said tariffs at 15% on 112 billion. Did we bold that? Yeah, why did I bold 15%, 112 million? Why did I bold it?
They're against like the numbers that they use. Like,
Yeah. Did everybody hear that? I bolded the numbers that I would be interested in. Do I have a photographic memory?
No.
I don't? I don't. Do I?
No.
Not at the company, so.
No. Do I?
Yes.
Yeah. Yeah. Yeah, I remember a lot of the numbers. So do you think that the managing directors and the senior level executives and your clients are super smart and they can read stuff and they can remember all the numbers?
Yeah.
Yep. These are smart people. We are data junkies. We look at numbers, we memorize it, because why are we memorizing the numbers? Why would we memorize the
Comparison for future years,
what?
maybe comparison for future years.
Yeah, exactly, look at comparisons. Why else would I memorize the numbers?
References.
Comparison to other companies.
References,
Credibility.
what?
Credibility.
Yeah, if I'm on the phone with an institutional investor that basically has 110 million shares,
You sound
You know-
credible.
I sound credible.
Right.
I can read off the GDP numbers, the unemployment, the market trends, all of that, the trade numbers, all of that stuff. I'm totally credible. Exactly. Okay. So all the top people totally memorize the numbers and then use those numbers in conversations to be able to communicate to their clients because their clients are on the phone scared, right, in most cases. Okay. All right. So he lays out the logic. Everything is correct. He probably might have pulled the data from 2 different sources or one source. Okay, and then edited it down. So he's not plagiarizing. But he bolds the data. So it pops out of the page. So I can scan it very quickly and go right to the numbers. Okay. With the new tariffs being targeted mostly at consumer goods, inflation is subject to rise. Inflation exceeded its forecast from 1.6% in June to 1.8% in July. Okay, that's an analyst. Okay, so he's writing like an analyst, and he and I worked very closely together to craft this language. So if you get the numbers in and you make an attempt, we will go over it. I'll read it together, and I'll have my TAs go over it with you, and we'll train you how to write at business quality level. Okay, because usually the English and the communications that they train you in undergrad is not what you use at the corporate level. The standards are higher. Okay, so I got to train you on how to write at a very high quality level. And if you can learn that stuff now, when you get that job, they're going to be handing you stuff to do, and you're going to be writing up the analysis. They're going to check it, give you some recommendations. You're going to go back and correct it. You're going to give it back to them. They're going to look at it. They're going to go, "This is perfect." Send it out to the client. Okay, that's how we do it. So the data and analysis basically supports your forecast, and then the trades are just automatic. It's binary. Okay, it's a decision rule, and then he's got the graphs basically to back it up. And then what you do is you copy the introduction, okay, paste it at the conclusion, change the colon to a period, and change following to above. Why would I do that? Why would I basically restate my thesis statement in my concluding remarks?
Is the main point?
Give me some other stuff. Why would I restate the thesis statement?
So now that you have information about your data, you're concluding your statement.
Give context.
Yeah, you're refreshing the reader's memory, and you're closing the transaction. You're selling them on your trades. So you're restating it again, reinforcing it, and you're bringing it all together. Okay? So the memos are freaking awesome, powerful tools. Okay, there's a lot here. Okay, but once you get into it, it gets awesome, and you can use this as basically writing samples to show prospective employers for internships and jobs. They're going to ask for writing samples. Okay. Do you know anything about oil prices? Read my oil memo. Do you know anything about stocks? Read my stock memo. No, seriously. I had 2 people gotten jobs because they asked them, "Do you know anything about oil prices? Here, let me shoot you over my oil memo that I wrote." She got the job. Another person said the same thing. "Do you know anything about stocks?" "Yeah, I do. Here, read my stock memo." He got the job too. So it's just writing samples. Okay, so it works. So let's do the, how much time do I have?
That depends, where are you trying to finish?
Huh?
Where are you trying to finish?
I don't know. I'm going to burn out here pretty soon.
It's 8:35.
And then I'm not going to freaking 10. so let's do the derivatives, okay? Let's do the derivatives, and then the memo's done, okay? Then we'll come back and we'll work on the pretest. So do the pretest, okay? Read through the whole thing, okay, all the way to the end, all right? And then we'll go through it, and it'll probably take a couple nights to go through that too. And then, no, like next week. But I want to focus on the memos. What? Yeah, but we'll just extend it, because I want to go through it. But the first half of it should be done, not the second half. And then we'll go through the pre-test, and the questions that you couldn't answer, I'll go over those. Okay? And then the last part of the pre-test, I'll go through it in detail. Okay? Because again, once we've done the pre-test, that sets a really solid foundation to then build on, to go forward in the class and then start moving into portfolio construction and stuff like that.
Is the quiz still due next week, or is that when Bill's?
The quiz, is the quiz due next week? No, let's just keep extending it, I'll give you a little extra time. I'm not neurotic about dates,
Okay.
but I am neurotic about checking your work and making sure that you're on track. If I get to say, okay, next week everything's done, and you didn't do anything, then I'm gonna be going, well, what the hell have you done over the last month? Okay. Even procrastinating. And then what you're gonna do is you're gonna go try to do the stuff, and you're gonna be totally overwhelmed, you're gonna be really mad at me, and you're gonna give me bad review, okay, on my evaluations at the end of the class. Okay, so you gotta be self-motivated, okay, and work in teams, okay, and hold yourself and your team members accountable.
Okay, so just to reiterate, next class, the memos due, the following class, the
Yeah,
pretest.
do the memos.
Yeah, okay, so next class, the memo, following class, pretest, following class, quiz, or no?
Yeah, let's do that.
Yeah,
Yeah, let's do that.
Yeah.
Yeah, so we've already negotiated. Yeah. And then I want the whole package, the deliverable package. It's a deliverable package that you hand in.
Oh, that's quiz 2 and 3, yeah? Because we had that.
Hold on. You should be building the deliverable package, okay? You should be building the deliverable package. Look at the syllabus. Okay, everybody goes, what are you talking about? Well, did you read the syllabus? No. Read the syllabus. Okay.
It's them combined.
Yeah. So you're building product
I got it.
to then put the deliverable package together to then submit to me the deliverable. Okay? It's not, oh, here, Professor Susie, here's my, oh, here's my exam. It's like, no. It's like, put it together, build it, show me it. Professor, how's the deliverable looking? Yeah, this looks great. Okay, let's go over some stuff. Because I want all the deliverable packages to be at the same level, okay? Not this scatter shot of quality across everybody. I want everybody's deliverable to be good, okay? When I take a first look.
So do you want our deliverables to be handed in, like, as soon as we do the quiz, or like for the week of the pre-test? So like,
The quiz.
okay, the quiz, okay.
So what did we say? What did we just negotiate? So
Yeah,
you have to listen.
Yeah.
So
Memo, pretest, quiz.
But the day of the quiz, once the quiz is due, what's due?
Deliverable.
Got it. It's everything that's due. So I'm gonna check everything.
Yeah.
And then next week, I'm gonna check the memos. Following week, I'm gonna check the pre-test. We're gonna go over the pre-test next week. Okay, so you'll be able to fill it. Then the quiz is gonna be due, the homework's gonna be due. You're gonna have, you know, what is it? 2 weeks, you're gonna have the deliverable package due. You're gonna deliver it.
And you want the first half of the pretest next week?
Yeah, and then I'll do the second half of it. Might take us a little bit longer to go over it because I really want to go over it. The second half of the pre-test is critical that you learn this stuff.
The theory, right?
Application of the theory. Okay, it's critical because the book presents it a little bit differently than I do. Okay? Some people like the book, right? But I'm going to teach you application. Okay? I'm going to teach you my way, which is a better way.
That's why, right?
It's my way. Okay. All right. So let's do the derivative traits and then get out of here. Okay. All right. So everybody's going to have the first half of the pre-test done by next week, and the memo, and I'm going to check it.
by memos together, right?
No, just one.
Only one.
Yep, I want to check it and make sure that you guys know how to do it. Okay? And I'll spot check it, give you some comments, and then give it back to you. Okay? If you want to race ahead and do some of the other memos, you can do that too. I don't care.
So, the memos, like, we only
Okay,
need one memo,
Talk to him,
but the rest are deal with the deliverables.
did you read the syllabus?
I did.
Okay, and then for deliverable one, how many memos are due?
One,
If you want to do two, would I say no?
no,
What's better, more or less?
More.
But it's up to you. I'm not gonna micromanage you. I'm not gonna self-motivate you. You guys are all adults. You know what to do. You know, in my classes, when I was going through grad school, I set my own quality standard because I had been working, right? Other students had never worked, okay? I had higher work product standards. So I blew away the competition, okay? I was getting A+, because I was doing stuff at business level quality stuff. Other students never worked, okay? They didn't know any better. So you set your own agenda, but you gotta set a very high quality level, okay? And if you got any questions, text me, call me. You gotta put together the homework, okay? Put together the package. Make sure your cover page is beautiful, okay? Everybody clear? What we're doing? Okay, excellent. So let's do the derivatives, so you can understand it. The book has the derivatives. Fast forward, go read up on the derivatives, but I'll give you kind of a quick primer on the derivatives. All right, let's do forward contracts. Forward contracts. Okay. Forward contracts, futures contracts. Forward contracts, futures contracts. Okay, they're very similar, but they have different characteristics. Forward contracts are over the counter. You want to be writing these notes, over the counter. They trade in the over the counter market or the OTC. Okay, over the counter. It's a private marketplace. Forwards do not trade on an exchange. They trade in the open market. So I got two clients. I got a corporate client, a multinational, global multinational corporation, and I got a bank, okay? Institutional level. I got two counterparties to the trade, okay? I think the values are going to go down, so I need to find somebody who's going to take the other side of the position. I think values are going to go down. I'm going to write the forward contract. I got to find somebody to buy the forward contract that thinks that the prices are going to go up. Me, the investment banker, are going to arrange basically the counterparties, bring them together, and negotiate the contract, the forward contract. I'm going to work with the securities attorney to write up the contract between the two counterparties that lays out the legal agreement between the two. Okay, is everybody clear so far? Okay. These markets are highly liquid, but they're opaque. Okay? So if I want to unwind or if I want to sell my position, I got to go to the investment bank and basically unwind the position or sell my position in the private market, and they got to make calls to institutional investors to try to find somebody to take the other side of the trade. Okay? So the risk in forward contracts is counterparty risk. Okay? Counterparty risk. All right? So I think that prices are going to go down, and I'm writing the forward contract. Okay? But I didn't receive any money yet. And I got a counterparty that bought the forward contract that I wrote. Okay? At the end of the forward period, at the end of the 2-year period, values went down. So the person who thought values were going to go up lost. But the counterparty went bankrupt and didn't pay me the money. So now there's counterparty risk. That's why forward contracts are only done at the institutional level, where the counterparty risk is very low because the counterparties have balance sheets to be able to execute on the trades. During the financial crisis, the best financial institutions and corporations were totally impaired, and the counterparty risk was severe because the counterparties were defaulted or insolvent or bankrupt. And the Federal Reserve had to come in and make those trades whole to create liquidity in the system to allow those trades to clear. Okay, that's the extreme case. So counterparty risk is big. Okay, so here's an example of a forward contract. So we're going to do a 2-year forward contract. Now the values, there's going to be some exercise price. I use X as the exercise price. And then you think the value of the index could be a stock index, could be a bond index, could be an oil index, could be a gold index, whatever it is. Okay. Let's say it's oil. Okay. And we think, we're a company, we're a transportation company. And oil and oil prices and gas prices is a major component of inputs, into our production process, cost. Right? So as oil prices go up, gasoline prices go up, basically our cost structures go up, our margins go down, and could cause our stock price to go down because it eroded our profit margins. So we're trying to hedge off the market risk associated with rising oil prices. Okay? That could be one. Or I could be an oil company, okay, that thinks that oil prices are going to go down. Now, if I'm an oil company and I produce oil, refine oil, and sell oil, and oil prices are going down, what happens to my revenues? Go down. What happens to my earnings? Down profits, stock price, so I can hedge off. Can't I hedge off market risk by writing a forward contract? I think oil prices are going to go down over the next 2 years, so it's going to erode my earnings and my revenue. So to hedge off the deterioration or the negative impact on my profits and on my revenues, I can write a 2-year forward contract where basically I can backfill my revenue losses by gains in the forward contract. So I'm hedging off my exposure that way too. So if I think that prices are going to go up, I'm going to buy the forward contract. Buy it, or I'm going to go long. So I'm going long the position. I'm buying long. Okay? If I think that the prices are going to go down, and I want to hedge off my risk, then I'm going to write the contract. I'm going to go short or short the market. These are all terminologies that I'm using. Okay. So let's just say that the exercise price on the index is 1,000, and it goes to 2,000 in the future. Okay. So I'm going to make 1,000 if I'm right? Because what happens is if it goes up, I'm going to be able to buy it here and then sell it here. So that's how I make my money. Here, if the prices go down, I'm basically going to be able to sell it here. Okay? Sell it up here, right, from here. So I'm going to hedge off. I'm going to make money. So I can make money in any direction. Right? It depends on who I am that's using the derivative contracts as the tool to speculate on my view or to hedge off my position, to hedge off the market risk. Now, in a forward contract, the contracts settle at the end of the period. So no money changes hands until the exercise date at the end of the 2-year period. Okay? So So that's basically the forward contracts. Is everybody clear? It's very simple. Now, the futures contracts are very similar, okay? Now, I can buy a futures contract betting on price movements on the index 2 years in advance. So it's today, but it's basically saying, where's the price going to be in 2 years from now? Okay? And every day, that 2-year view changes, right? Well, I'm buying 2 years in advance. What people think the prices are going to be in 2 years from now. Okay? So it's a forward-looking. It's forward-looking. I'm hedging off the 2-year view, but the 2-year view is going to change every day. Okay. Now, what happens in these futures contracts? So I'm buying a 2-year futures contract. There's futures prices that are going to move based on movements in the underlying index. That's why they're called derivatives. Okay? So derivatives, you're not buying the underlying asset. You're buying a derivative contract where the value of the contract is based off of some underlying asset or some underlying index. Okay? In the most extreme case are the option contracts that are written or bought based on movements in futures prices, based on movements in indexes. So it's a derivative of a derivative. Okay? And you'll learn a little bit about CDOs and other types of derivative on derivative contracts. The derivatives market was invented in the 1970s, okay, by Wall Street bankers and financial engineers, because the Federal Reserve moved monetary policy from targeting interest rates to targeting the money supply and allowing interest rates to fluctuate. And that basically exposed the banking industry to interest rate risk. And instead of being exposed or naked to interest rate volatility in the marketplace, Wall Street created interest rate derivative contracts and swap contracts to allow for banks to hedge off interest rate risk. So Wall Street and financial engineers basically listen to their clients and the problems that they're confronting, and they engineer financial products and instruments as tools to solve the problem. So finance is not analysis. Finance is a technology that solves problems through instruments and mathematics and technology. Okay? Everybody gets it wrong. They think of finance as mathematics and analysis and stuff like that. No, it's engineering. It's product development. And you design a product to solve a problem. And then you make a market in those instruments. And then provide that to you. That service to your clients. That's why Goldman, JP Morgan, all of those banks, Deutsche, Santander, a lot of the big banks, that's why they're so profitable and that's why they're so smart, is because they engineer product. Okay? And you guys are all engineers. Okay. So futures contracts, okay? Basically, I'm buying a 2-year futures contract, okay? And the movement in the price of the futures contract is based on views of where they think the prices are going to be 2 years from now, okay? And they're volatile, right? So the actual futures prices are going to be volatile. They're more volatile. Now what happens is, let's see if I can do this correctly. The problem is that futures prices could go something like this. So I bought my position, my 2-year futures contract, goes out for 2 years. But the volatility goes something like this. Before it goes like that. Okay. So here's my exercise price. So every day, the futures price changes. And some days, it could be above the exercise, some days it could be below. Okay? Now the problem is, when the prices go down below the exercise, the contracts are marked to market on a daily basis, and they settle on a daily basis. Okay? It's a 2-year view, but today, my futures prices are out of the money, and I basically got a margin call, and I gotta take the money out of my account and pay off the other person. Okay? But the days where the prices are above, I'm in the money, and money goes into my brokerage account. So one day, money's going out, one day, money's going in because it settles on a daily basis. So futures trading, you have to have capital and you have to have experience, okay, to trade futures contracts. And the biggest futures trading system is the Chicago Mercantile Exchange out of Chicago. Okay. So they've standardized the contracts. Futures contracts are standardized contracts. They're highly liquid, and the exchange basically matches the writers with the buyers of the futures contracts. The traders, the people who take the positions, got to put up margin to cushion the losses if the counterparties default, and the exchange absorbs the losses if there's any counterparty risk. So the exchanges absorb the losses, but the losses aren't severe. These exchanges are highly profitable. Okay, so you have an intermediary that standardizes the contracts. Okay, and basically creates a trading system, an information system to match the futures contracts, the writers and the buyers. Okay,
I just wanted to confirm, so after 2 years, basically, if the price...
it's just a view.
Okay.
You're entering into a futures contract where the price of the futures contract is based on the view of where prices are going to be in 2 years from now.
So once 2 years hits and it's at 2,000, then do I get the share for, say, $1,000 and sell it off?
No, because what happens is the indexes and the futures prices converge at the end of the 2-year period. Okay, it's called backwardation or contango are the two terminology. So when you approach the 2 years, the index and the futures price converge to each other.
So what is the exercise pricing? Is that just what I bought it for?
That's just the price in which you're going to exercise it at.
Yeah,
So all of a sudden, let's say it's 1,000, and the index goes to 2,000, I can basically exercise the futures contract here and pocket the money.
Yeah.
Okay?
Okay. And if it goes below, like if it's...
Then the money goes out.
I just don't exercise?
No, well, what happens is, he's asking a really good question. Let me go through it, okay? So you're just basically buying a contract, in this case, where you think oil prices are going to be in 2 years from now, okay? You entered the contract, all right? And basically the futures price is going to move based on people's view of where they think oil prices are going to be in 2 years from now, okay? So since it's mark to market, right, every day, at the end of every day, if you're in the money, you get the money. If you're out of the money, you got to pay the money. If you don't have enough money to pay the money, you're going to get a margin call. And if you can't pay it, you got to put up the money, or they'll liquidate the position. Okay? But if the money starts to go down, you're going to get a margin call from the brokerage, and it's going to say you need to put up the money. You got enough money in your account to basically put up, to settle the position, But if it moves a little bit more, we're liquidating the position, and we're gonna take the money, because we're not gonna absorb your loss. So, futures traders, it's really, you gotta have the money to be able to handle the losses. So in this case, this person was losing money here, since they thought it was, prices were gonna go up, they bought a long position in a futures contract. But here they were losing money, they stayed in their position, but they had to pay basically the writer, of the contract here. But if they held on to the position, all of a sudden oil prices took off. And they were in the money, and they were in a profitable trade, and they could exercise it anymore. Okay? Now the person that thought things were going down could be the same scenario, right? But things went down like that instead. Well, if I bought a long position, I'm in a negative position. So what I'm gonna do, am I gonna hold this position? No, heck no. So what do? Since you bought it, since you bought a position, because you thought it was gonna go up, you don't sell, you write a position. So since you bought the futures contract, but your trade went against you, and you started losing money, you write the futures contract, cancel out the position before your losses get too big. Okay? Does everybody understand? That's a key component to the trading futures contracts.
Like
When
going back
the
to
contracts go against you, you just take the other position and you cancel out the trades. And you get out before you lose.
so like back to like forwards, like how do you hedge off your losses better by using a forward?
Not
compared to
everybody can
shorting?
use forward contracts, because only institutional investors, but I'm a retail investor. I may be a mid-sized company or a small company that needs to hedge off. I can't enter into a forward contract because I'm on the balance sheet. So what I have to do is I gotta go to the futures market and basically trade futures contracts on the exchanges to basically hedge off my risk or speculate in these markets.
So like how is it like different than just like shorting a position on your own firm? Like how does it help you hedge off your losses better on it? You know what I mean?
Oh, for the futures contracts?
Yeah.
One is they're cheaper, they're more liquid, they're standardized. The problem is that you gotta settle on a daily basis, is the biggest problem.
So the person loses the interest benefit if they're not going?
What?
So the person loses the interest benefit if they're like not going?
Interest?
Yeah.
I don't understand the terminology.
How does the interest rate affect the future?
How futures prices,
Yeah.
how interest rates affect the futures prices?
Yeah.
Well, one, it depends on what our interest rate movement, what effect they're gonna have on it. Well, if this is a bond index, right, and interest rates go up, then bond prices go down, right? But if you thought that interest rates were gonna go down and bond prices were gonna go up, you're gonna lose, right? So you have to unwind your position. Does that make sense? Yeah.
Yeah.
Yeah, and then interest rates also determine, or inflation or returns also have an impact on forward futures prices too. I don't know if that makes sense.
Yeah.
Okay, so does everybody understand here? I took a long position, but the prices went down, so I started bleeding money. So basically what I did was I wrote a futures contract to cancel out the losses. Maybe I went short, I wrote the contract, I thought prices were gonna go down, but prices started to go up, I started losing money. So if I wrote the contract and prices went up, I'm gonna buy a futures contract and cancel out my short position. Does that make sense? Okay, so futures traders never hold their positions till the end. They exercise the positions at some point once they're profitable. They get out. And if the positions go against them, they cancel out the position by taking the opposite trade.
Are futures and forward contracts obligatory, or like, do they have to pay at the strike price?
Yeah, there's a strike.
Yeah.
associated with it.
Are they obligated to go through with the contract, like, they can't?
They are contracts.
So they cannot cancel it?
The futures contracts, you can take the offsetting position. The forward contract, you have to sell your position. You can't cancel it. You can't go to the counterparty and say, I want to unwind my position. It's like, well, we have a 2-year contract. I'm in the money, you're out of the money, now you want to unwind the trade. I'm going to sue you for basically contract violation.
You're not obligated with calls because calls.
Options, right?
Yeah. because
Options are
calls
different.
the right to
And I'll get into
buy,
the options
you're not
in a
obligated.
second, John. Okay. So is everybody clear on the difference between forward and futures contracts? You know, and how they trade and how you can be in and out of the money?
I had a question on, so like, if I buy something for 2 years from now and
No, it's not 2 years from now. You're buying a contract based on a 2-year view
Mhm.
on where it's gonna be in the future.
So I bet that its price is gonna go up and the exercise price is
And
gonna
you
go
think
down.
the index is gonna go up,
Yeah,
okay? So the index is going up, right? And then the futures contract is trading,
mhm,
right? And then at some point at the end of the 2-year period, the futures price and the index are gonna converge. Because the closer you get to the 2-year end date, we know where the pricing is gonna be.
yeah,
Yeah, because there's only this 3 days before the contract expires, I'm gonna know where the index level is.
so basically my question is like, when the 2 years are up and I still, if, say I have to sell my position.
Or you held your position till the end,
Yeah, and then I exercise it, does that basically mean that
and you're gonna profit that if you were correct. 'Cause this was the index. This is what you can buy it at, this is what you can sell it at, you're gonna make the profit on the spread.
So how's that different from an option?
I'll do the options next. Okay. So these are forward and futures contracts, this is how you look at it. Now, the option contracts are different. It's a different graphic. And I'm gonna change the graphics to make it a little bit easier to understand. I'm almost done. How much time do I have? Like 2.5 hours.
You got like 5 minutes.
Based on your time sheet. Okay, exercise price. Can everybody see this? So we go like this. So the first thing we're gonna do is we're gonna buy a call option. Buy a call. So when I buy a call, what am I betting on? Price is going up or down? How am I gonna profit? Up. Got it. Do I have to pay a premium
Yeah.
to buy the call? Yeah. So is that money going in or out?
Out.
Out. Got it. So it's a negative. Got it. And this is the price. And this is the exercise price. So as the price goes up, I haven't made any money yet. At some point in time, the price is gonna compensate me. The increase in the price is gonna compensate me for the premium that I paid, so I'm gonna reach some kind of break even. And if the stock price or the index or whatever it is, the futures price, my call option, let's see, that's the price. Let's say the exercise price is $50. The price of the stock or the index went to 100, or let's say $100. So how much am I in the money?
50.
50. And I paid $5 to buy the premium. So what's my profit?
45.
Got it.
Wait, Professor, we bought it at 50?
Now, the exercise price is 50.
Okay, what did we buy it
Yeah, what you would do is when you exercise it,
at? Uh-huh.
the exercise price is at 50, but it went to 100, so you bought it at 50 and you sold it at 100.
Okay, and then the premium's 5, so that's the problem with that.
Exactly.
Okay.
Okay. All right. So that's pretty straightforward. And then for the put option, and I'm going to do it this way because it's just easier to, it's not theoretically correct, but it's intuitively easier to understand. So the put option, so what's my view? How am I going to make money in
You're betting it's gonna go down.
Exactly.
Yeah.
I put, am I gonna pay a premium? Yep.
Uh-huh.
Is money going out or in?
This is writing.
I'm buying a put, right? Do I have to pay for that put?
Yes.
Yes.
Do I have to pay a premium?
Yes.
Is money going out of my pocket or in my pocket?
Out of your
Got it. Okay, so you got the premium. So the exercise price is 50, but the share drops to 25. Got it. So how much money in the money? 25 bucks.
Minus the premium.
Minus the $5 premium.
Profit is 20.
Right, 20. Got it. And these option contracts, you multiply by 100. Each of the contracts are 100 shares. So you multiply, they're standardized, option contracts are standardized. For 100 shares each contract. Okay? I'm not gonna do that. All right, so we
Wait,
did,
Professor?
How long do you?
yep.
I'm pretty sure the put contract goes up and then
No,
down.
I know it does. I'm just doing it this way because it's easier.
Oh, okay,
I'm just doing it this way because it's just easier.
got it.
Oh, for the
Because it's theoretically incorrect, but it's intuitively easier to understand this way. Okay, go ahead.
For the buy call, the strike price was 50, but was the price 50 of like the underlying stock when you bought it?
For this one, the put,
No, the call.
the call. So basically, the call is you buy it at 50, sell it at 100, 50% spread in the money minus the premium you pay, it's gonna be your profit of 45.
Okay, so you bought it when it was at 50 and the strike price was also.
You exercised it. So you bought, theoretically, you could buy it at 50 and sell it at 100. So you made a profit, minus the premium. That's how you make the money. This one, basically, I can sell it at 50.
What's the y-axis in that graph?
This one,
Yeah,
this is the price.
the stock price, but when the buy call, the line starts below 50.
Because you're paying the premium. So you're out of the money right off the bat. So the stock price has to go up a lot first to compensate you for the premium that you paid. So you started at negative.
I think what he's saying is like, wouldn't the y-axis then represent like the profit?
Yeah, like, if the buy call.
No, it's just the price.
Okay.
It's the price.
Doesn't that show that like you're buying it, say like around 45 or so, like or a few
Where?
dollars less?
Where?
Because if the y-axis is the price of the stock.
It's the price of the stock.
And then the buy call,
At 100.
see how the line when it starts, it's below the $50 one.
Right, so it's gonna be, you're right, it's 45 bucks.
So if you bought it when it was 45 and then it goes to 100 and there's a $5 premium, wouldn't you make $50?
Here?
Because when it goes from 45 to 50, that's when you break even, and then it goes to 50 to 100.
It's not at 45, it's at 50.
It's at 50, but the premium is 5.
But you're paying $5.
Why is the line below?
Because you paid the premium. So
Okay,
you started at negative. So the stock price has got to go up to compensate you for the $5 for the premium that you paid for the option.
So you didn't buy it when it was below 50, you bought it at 50.
That's just the exercise price.
No, I'm talking about when you bought the option.
When I bought the option, I paid $5.
Yeah, I'm saying what was the price of the stock at when you bought it?
It doesn't matter,
Doesn't matter.
the strike price is 50.
It doesn't matter, you just started at negative. It has nothing to do with the stock price. It's what the stock price has got to go up to compensate you for the money that you paid, right? So you started at 45, right? If the stock price doesn't go up to 50, you're out of the money, the option expires, you lost your $5. So you have to, the stock price has got to go up to compensate you for the premium that you paid. Does that make sense? No? Yes?
So maybe you set the y-axis to the profit of the call. That will be easier to understand.
Instead of the price?
Yeah, instead of the stock price, just put the profit of the call or the buy a call, you just lose the premium at first,
Correct.
and then it goes
And then
up.
all of this is profit.
Yeah.
Okay, so you're in the money in this position. So you're in the money. And then if you buy a call option, right, the stock price doesn't go up, you're out of the money and you lose the premium, just the $5. Okay? So this is what I'm trying to do to make it a little bit easier. I can also, not only, if I think stock prices are gonna go up, I can not only buy the call option, but I can write a put option. Right, because I'm buying a put to make money when it goes down, I can write a put to make money when it goes up. So I take the other side of the position. So if I write a put, is money going in my pocket or out of my pocket? It's going in, so it's positive. So basically, if I think, this would be the ultimate trade, right? If I think that stock prices are gonna go up, could I write a put option? Pocket the $5. Buy the call option for basically a free trade. Can I do that? Yeah, I can do that too. Okay. So I can make money when prices go up by buying calls and trading bonds. Okay. Let me just finish. And then for when I think that prices are going to go down, I can buy a put. When I buy the put, is money going in or out of my pocket? When I buy the put, pay the premium, money's going out. And when I write the call, is money going in my pocket or out of my pocket? It's going in my pocket. So if I think stock prices are going to go down or indexes are going to go down, can I buy a put? Can I write a call, get the premium, and buy the put?
Yeah.
Yeah, and make a lot more money? Yeah, I can do that too. Yeah, go ahead.
So the only fee you're paying is a premium?
When you buy the put, you buy the call, you pay the premium.
Yeah, but if you go to like a brokerage firm, that's all they charge?
You gotta pay the, well, there might be some commission
Okay, so there's commission, premium,
to
and
trade
taxes.
the options contracts, and then you gotta pay the premium.
So, oh, okay,
Because when you buy stocks, you gotta pay
right.
commission,
And
right?
then when you sell it, let's say
You
you cash out.
exercise it, when you exercise the option.
Right, so when you exercise, you make the profit, but then I wanna like take my money out of the brokerage account, put it in my account at the bank, that's when I pay the taxes on it. I'm trying to find
Yeah,
out
any of your profits are gonna be,
capital gains.
for these, it's really income taxes.
Oh,
Yeah,
so depending on your tax bracket, that's the percentage.
because you didn't buy an underlying asset like a stock.
Oh,
So you didn't establish a cost basis. Because if you bought the stock at 25 and it goes to 50, or let's say you bought it at 25, goes to 50, you made $25, you're gonna pay capital gains on the 25, okay? And then if you do the option contracts, that becomes trading income. So you're gonna pay whatever your income tax on it.
Also, premium contracts it's not just $5, it can be like thousands of dollars
Sure.
per contract,
Right.
so it's usually
Yeah.
more expensive.
I'm
No, I
using this
use
as-
the premium just in this example. Like,
Yeah,
if
I'm
I
just
keep
using,
it on.
yeah, so different option contracts, okay?
Possibly.
Could be different in when you look at the literature, when you look at the book, the option pricing model, the Black-Scholes option pricing model, okay? The premium and the value of the option contract, when you price out an option contract using the Black-Scholes methodology, which he won Myron Scholes and Black basically won the Nobel Prize for coming up with this theory, which is used by all option traders and people who use option contracts. The two main factors that drive option values is time value. So I enter into an option contract for 3 months. because the option contracts, January, February, March, April, May, June, July, August, September, October, November, December. They trade in those 3 contract periods. So if I buy a contract, enter into an option contract on January 1st, and it expires March 30th, okay, there's going to be a lot of time in the contract. There's going to be a lot of time value. So the premium and the value of the contract is going to be determined because there's a lot of time. So as you start to get close to the expiration date, there's not a lot of time, so the time value starts to go down and the premiums start to go down too. So some option traders like to trade not at the beginning of the period,
But towards the,
like in the middle.
oh.
So they get a time value discount. Because there's not a lot of time value, so the options are cheaper because there's less time to expiration date. I think there's 3 months here, so if the price of the stock is highly volatile, there's a high probability that you could be in the money. But as you start to approach the expiration date, there's less probability that you're going to be in the money. So the time value is one component to the valuation. The other is volatility. So option values and option contracts are priced based on the volatility. So let's say you buy a stock that's highly volatile. There's a huge probability that you're going to be in the money compared to a stock that has low volatility. So an option contract that has a lot of time, based on a stock or an index or a futures contract, futures price, that's more volatile, the premium and the value of the option is going to be more because of the volatility. So it's time value and volatility are the 2 components that really drive option values and premiums. Okay? Yeah.
So can any regular person write an options contract or?
Yes and no. Okay. The writing the call options, most people cannot do that. Okay. Because you're betting that they're going to go down, right? The prices are going to go down, right? You wrote the call option because you thought prices were going to go down. How far can prices go? 0. Can they go negative?
No.
No. So are you limited in the amount of losses that you can lose? Or the money that you can make?
Yeah.
Right? But what about if you write a call and prices start going up? So you thought they're going to go down, but how far can prices go up?
Infinite.
Exactly. So the writer of the call option is in a precarious position. So let's say that, I'll test you guys on the logic. Let's say you wrote a call option and you thought the prices were going to go down. And all of a sudden, prices start going up. Are you losing money?
Yeah.
Yeah. So how would you hedge your position? You're now incurring losses or the potential. If that person exercises the option, you're going to lose money. So how would you mitigate your losses? You wrote the call, you would then
Buy
you would buy a call, offset the position. So you cancel it. It's not going to be a perfect offset, but it's going to mitigate your losses. Okay? Any other comments, questions on that? Okay, we'll finish it up. Oh, sorry, Sharon.
Oh, wow.
I owe you. I guess I'll give you 30 minutes, right? So,
Yeah.
okay. So the last part is buying on margin and selling short. It's pretty simple. Buying on margin, you're not buying the stock for $100. What you're doing is let's say I want to buy $100,000. I can buy $100,000 in shares, or I can buy on margin, open up a margin account at the brokerage firm. They're going to charge me 9%, interest rate on it. But I can borrow another $100,000, so I can buy $200,000 worth of shares instead of $100,000. So I'm basically using borrowed money. So So using margin is a way to leverage your return on equity by using borrowed money. So what happens is, if the stock price goes up, your return on equity goes up exponentially, because you're using borrowed money, it's leverage. Okay? But since you borrowed money to buy the stock, if the stock price goes down, your losses are exponential. Okay? And as this starts to occur, you're gonna get margin calls. And either you put up the money or the brokerage firm will liquidate your share positions to pay off your margin loan that you took from the brokerage firm. Okay? That's margin. Yeah.
Are you saying that goes exponentially up just because you're investing more? Is that the reason why it's exponential?
You're investing more based on borrowed money. I only put up a little equity, right? But I got control of more shares. So that magnitudes your return on equity. I put up a little, I control a lot. If the share values go up because I have more shares, my return on equity goes through the roof. It's an exponential, it's a two-edged sword. So it works. Margin works, leverage works in your favor when the prices go up, and if your trades go against you, it's an exponential losses. Then the last one is selling short. Okay? You basically sell short, you think stock prices are gonna go down. You sold, you basically lent the investor the shares at $100. You gave him $100, and the stock price went down to 25, you bought it back at 25, you made $75. You still wanted to stay in your position. You didn't want to liquidate the shares. You wanted to hold your position and basically use the shares that you owned to make money. So I already own the shares. I know the stock price is going to go down. I don't want to incur a loss. I might as well incur a profit. So what I'm going to do is I'm going to lend my shares to somebody that thinks that the stock price is going to go up, but they actually went down. And basically, they're going to, at some point, they're going to basically give the shares back to me, right? And I'm going to buy it back at the lower price. And basically, I sold at 100 and I bought it back at 25. So I can make money with the short term. So you can make money based on any direction of the movements in the prices, because the derivatives allow you to do that, and the trades allow you to do it.
With the assumption is there's always going to be someone that's on the opposite side.
Correct. It's only in severe financial
If the
crises.
sentiment is all shifted in one direction, who's going to want to buy, right?
Yeah, that was the biggest problem in the financial crisis, is there was nobody on the other side taking the trades. So like the guys in the big short, the guys who were shorting the mortgage markets and the mortgage-backed securities, their problem was liquidity, right? Could they unwind the trades at some point when the counterparties defaulted? So what they did was, as they were shorting the market, buying the puts, writing the calls, shorting the markets, at some point in time they had to exercise their positions because the liquidity was starting to dry up and the counterparties were getting ready to default. And then actually the Federal Reserve stepped in to basically clear the market because the counterparties were defaulting.
Oh, so the Fed paid them out?
The Fed basically bought out the positions that were sitting on the bank balance sheets that were counterparty defaulted either by them or their counterparties.
Sure.
And to incur those losses would have created a huge liquidity shortage in the capital markets and would have exacerbated the financial crisis even more and spill over into the real economy and create a depression. So the Federal Reserve became not only the lender of last resort, but the market maker of last resort. So it was extreme unorthodox monetary policy where the Federal Reserve had done nothing like this ever in the history since its inception in like 1913. So it was completely, they were settling all that stuff because there was no liquidity in the marketplace and the counterparties defaulted. Okay. The last thing, again, just one more that I've done. One more. I want to get back to, I'm sorry, what was your name again?
My My name is Kelly.
Kellen? Kellen said, what happens if the prices, go sideways? If they don't move up and down to basically go long, short, what happens? You just basically write these things. You start writing puts and call options, because they're never gonna be in the money. So that as you write the puts and the calls, and since the prices are gonna move sideways, the trades are never gonna be in the money. So as you write the puts and the calls, you're talking premiums.
What do you mean the price is moving sideways? I don't get it.
Well, if the price never goes above this,
Oh,
right, you bought the call, and I wrote the call, right? But if the price never goes up, the person who wrote the call actually pockets the money.
There's no volatility.
So you're out. Same thing here. Say you think the prices are gonna go down, but they never go down far enough. Since I wrote the put, I'm gonna pocket the money. So if I think the prices are gonna move sideways for 3 months or longer, I'm gonna be writing puts and calls and just pocketing as much premium as I can. Do you think people do that? Yeah, absolutely. Totally, when markets go sideways, they're writing puts and calls, pocketing. All right. Sorry I kept you guys.